Okay, so I think we're ready to go. So I was notified that there was a change of horses, so to speak, and the presenter will be Gill, and he's going to tell us something about uncertainty, risk, and capital growth. Great to have you with us, Gill. Floor is yours, 20 minutes. Looking forward to your presentation.
Thank you, first of all, very much for including the paper in the program. This is a joint paper with Ivan, and yes, I'm going to present, but I guess we're both are looking forward to Lorenzo's comments. And okay, so I'll start with some motivation. So common drivers of economic growth fluctuations are large and persistent movements in economic uncertainty, as occurred in the Great Recession and the COVID pandemic. And those changes in uncertainty can be interesting above and beyond first moment level shocks. So indeed, we have empirical literature that shows that high uncertainty is associated with a persistent decline in investment, consumption, and valuations. And that's actually quite challenging to explain in general equilibrium. I'll come back to those challenges later on. But more importantly, what is typically common to most existing models that explain this kind of evidence is that the capital dynamics are fully determined by the investment margin. Okay? So when investment goes down due to an increase in uncertainty, that causes the future capital to drop as well. Okay? Now, our paper provides novel empirical evidence that challenges this view. So we have three key findings. Our first finding is, I think, quite fundamental, but to the best of our knowledge, it was not shown before. We find that increased uncertainty is associated with higher capital growth, despite having a negative effect on investment. And this can seem surprising, given that investment is usually synonymous with a change in capital, but that's only the case if a firm's depreciation rate is constant, right? So if depreciation rate was time varying, and dropped itself in times of high uncertainty, that can actually conserve capital for the future. And that's actually the second finding in the data. And we actually go a little bit deeper into what could drive changes in depreciation. And we suggest that the utilization of existing capital significantly drops in times of high uncertainty. And that can explain both the decline in depreciation and the increase in capital. So collectively, these findings do impose a further challenge for general equilibrium models with uncertainty risks. So to be clear, this study has two contributions. Okay, so first, we're going to document the three findings that I mentioned, and then we're going to develop a mechanism to reconcile the evidence where the channel relies on two simple ingredients. The utilization is time varying, and it's related positively to depreciation. And the other one is that shocks to depreciation are going to have a persistent effect on the rate. And both of those ingredients are confirmed in the data. And in a nutshell, in the mechanism, when uncertainty rises and the agent wants to save, the precautionary saving is done by lowering utilization instead of increasing investment. Because lower utilization persistently decreases depreciation, and it simultaneously, this lower utilization causes investment to drop because it effectively lowers the future marginal product of capital. And the depreciation effect is going to be strong enough that it counterweight the falling investment, so the capital is actually going to grow in the future. Now, a result of this mechanism that I'll discuss is that flexible utilization is an important determinant of both aggregate and cross-sectional risk premium. And in particular, we show that stock price exposure to uncertainty risk depends on the utilization rate. I'll talk about that. And I'll also just briefly mention that we have evidence in the paper that our channel is quantitatively important and even necessary, I should say, when it's nested in a new Keynesian framework, which has time-varying markups, which we know can also induce uncertainty-driven recession. So overall, I think the paper can shed maybe some new light on the propagation of uncertainty shocks in capital markets. And so in the rest of the presentation, I'll talk briefly about the empirics and then about the theoretical contribution. So to start with the empirics, here's how first we're going to measure macro uncertainty. So macro uncertainty is denoted by V, and it's aimed to capture a predictable variation in macro growth variable of interest Y. So to construct V, we follow a predictive approach that is quite common in the literature. So we filter Y through an ARK model to remove kind of predictable components and obtain residuals epsilons. And we then we then construct the realized variance of those macro residuals and project the log of the future realized variance on predictive variables denoted by gamma in order to identify the ex ante variation. So the exponentiated fitted value, that's going to be V, meaning the predictable variation of Y. So we provide, by the way, robustness checks for this approach. And so in the benchmark case, Y, that variable will be industrial production that is available at monthly frequency. And the set of predictors will be lagged realized variance, the risk-free rate, the market return, and inflation. And to illustrate just quickly the cyclicality of the realized variance or the ex-ante macro uncertainty, we plot them here together, kind of smooth over 3 years. And you can see that the dashed line, that's the ex-ante uncertainty. And it's more persistent and it is less volatile compared to the realized variance, but both measures are counter-cyclical and rise in NBR sessions. So let's just start with plain correlations, okay, in the column in the left. So the table here shows the contemporaneous correlation between macro uncertainty V and the growth of variable of interest that include non-residential investment rate I over K, non-residential depreciation rate delta, capacity utilization U, and the stock of non-residential capital K. And just to ensure stationarity, we use the log growth rate of those variables. So the correlation between V, it's negative with the growth of investment or depreciation and utilization. And that's just consistent, I think, with the traditional view that uncertainty at least deepens recessions. More surprisingly, I think the correlation between V and the growth of capital K is positive. And that's not specific to the ex-ante uncertainty measure. You can get the same thing if you use realized variance in the right column. Now, this correlation evidence is maybe suggestive of certain links, but of course, we also need to control for first moment level shocks, let's call them G, which are equal to the log consumption growth in the benchmark. So we regress the growth rate of a variable Y between year T-1 and 8 years ahead on the current first and second moment macro proxies. And the slope coefficient of uncertainty, that's beta V. And brackets are in UST statistics. So the first fact here is that beta V is negative for investment depreciation and utilization, but the slope coefficient is more negative for depreciation and utilization. So for example, at the 3-year horizon, you can see beta V is like minus 0.34 for depreciation versus minus 0.20 for investment. And that would immediately indicate that for capital growth, beta V should be positive or at least non-negative, which is again one of our key novel findings. Now you can see the same evidence if you use impulse response projections, like here when I use smooth local projections. So consistent with the first finding, the negative effect of uncertainty on investment can be significant up to 7 years, but the impact of uncertainty on depreciation is more pronounced. So 1 year after the shock, the magnitude of the depreciation growth impulse response is twice as large than that of investment. And the impulse response to depreciation will remain negative for the next 15 years. So this asymmetry kind of a magnitude gives rise to a positive and significant increase in capital growth following uncertainty shock. And that's in line with fact 2. And lastly, on the empirics, we will show that utilization and depreciation are strongly related to each other, especially in long horizon. So we regress the future cumulative depreciation growth rate on the current depreciation growth and the current utilization. And now the first row in this table, the current depreciation regressor is just omitted. Okay, so the slope coefficient is just the plain correlation between depreciation and utilization. It's sizable, it's about 0.52. And we also find that utilization has a positive and persistent effect, okay, on future depreciation growth at longer horizons, which we'll use. Okay, now we do some robustness checks for all of those findings. In particular, we can show that the effect of uncertainty on capital depreciation is unchanged when we use like Koleski impulse responses or let's say GARCH to construct the macro uncertainty. But I want to jump to the theoretical part. Okay, so here's the framework to think about those facts, which is quite standard, I think. So the firm owns a capital stock K, which is has the following law of motion: that depreciation rate will be time varying. Phi is a concave adjustment cost function, and the firm controls its utilization rate denoted by U, and that governs the intensity of using the assets in place. And increasing utilization shortens the service life of equipment. So a positive change in utilization is akin to a positive depreciation change. Okay? The depreciation change or shock is given here. You can see it depends positively on utilization. That's consistent with the data. Now, a key ingredient that does separate this framework from maybe other studies is that depreciation dynamics are persistent.
10.
Yes. So this kind of looks like the capital accumulation equation, but it applies to the depreciation rate. And so the persistent impact of the depreciation change on the rate is motivated by the empirical evidence that I presented, but I will also try to structurally estimate the model to match the persistence of depreciation to the data. That will determine the parameter rho delta. And look, we do not provide micro foundation for this persistence, but I do think that any endogenous persistence in utilization, maybe coming from adjustment cost, can lead to this type of dynamics in depreciation. Now, output is produced using a constant returns to scale function over K, labor L, utilization U, and A, that's the level of productivity. You can see here that higher utilization increases output. And the log growth of productivity is just an error-one process with time-varying conditional log volatility governed by sigma A. Dividend is, of course, just output net of investment and wages, and the firm selects, labor, investment, and utilization to maximize value. And lastly, household has options in preferences with standard FOC, you get the regular SDF. So just to understand the utilization choice first, if there was no persistence in depreciation, the choice is static, and it's optimal when the marginal benefit of utilization, that's its marginal product, equals to its marginal cost, which is a marginally higher depreciation rate, epsilon prime, applies to the value of capital. Now, when depreciation rate is persistent, the utilization choice actually becomes dynamic, and its optimal value is given here. Now, it actually has a similar flavor to the static condition, but just note that this dynamic choice implies that when discount rate M falls, the net present value of future capital increases. And that will create a larger cost for having utilization being high. And I'll use that in the logic. Okay, so here are the model parameters. Relative risk aversion and IAS are pretty standard in production-based asset pricing models, but all other parameters are estimated in SMM. We have 22 moments and 10 parameters. And in particular, to estimate the parameters of productivity and its volatility, we use both the unconditional volatility and autocorrelation of consumption, output, and investments, but more importantly, we construct the realized volatility of quarterly consumption, output, and investment using a 20-quarter rolling window standard deviation, and then we target the standard deviation and autocorrelation of those realized volatilities, which help us identify the volatility parameters. And the autocorrelation of the empirical depreciation rate identifies rho delta, and that's actually ended up being quite persistent. So the next table just lists all of the moments we use against the data. I just should just say that all of the moments imply moments of fall all of the data moments fall in the model confidence interval, including for the unconditional moments of those different variables and the rolling standard deviations. So let's first understand the challenges of a model with fixed utilization. So look, first, by construction, utilization and depreciation do not change in response to uncertainty, which is not consistent with the first fact. But again, that's just by construction. More importantly, when uncertainty increases, there is a higher chance of low future consumption. So as a hedge, the household wants to save, to create a buffer of capital, meaning the SDF's volatility rises, that lowers the risk-free rate, that increases the discounted MPK, and it raises investment. So the precautionary saving is done by new investment, in contrast with uncertainty depressing investment. And lastly, because of this capital buildup, the future output also rises, which is counterfactual, whereas consumption drops to support savings and it diverges from investment. And that's another counterfactual. So what happens if we include the ingredients that we have? So when uncertainty rises, first of all, as I explained, discount rates fall, like the risk-free rate. So that increases the NPV of future capital. So the cost of future depreciation is larger. and utilization is more costly, so utilization drops. In other words, the firm can benefit from lower utilization because that will persistently lower depreciation and then conserve capital to the future, which becomes more valuable due to the lower discount rate. And because uncertainty shocks are persistent, the same logic applies to future periods. So uncertainty drops persistently. So as a result, the depreciation rate also falls persistently, and that's consistent with fact one. Now, there are two forces on investment. The risk-free rate drops, which increases the discounted value of the future MPK. That operates to raise investment. That's the usual precautionary saving motive. But also, we know that the future utilization rate is expected to decline. And that's really just isomorphic to a drop in productivity, right? You can see this if you write the MPK as solo residual times capital, where the residual will depend on utilization. So with persistent depreciation, the second force dominates. So investment drops. And the decreased utilization effectively replaces an increase in investment for precautionary saving. Right. Now, in equilibrium, the effect of uncertainty on utilization and depreciation is larger than the effect on investment, because as I described in the previous slide, investment is driven by two opposite effects. And that means that the drop in depreciation dominates. So the future capital growth overshoots, consistent with the second finding. And now, jumping to the asset pricing implications, the model can produce a sizable equity premium on a levered dividend claim and match risk-free rate moments. In fact, panel B shows about 25% of the equity premium comes from compensation of uncertainty risk, which is similar to the long-term risk model. Now, if we shut down our ingredients, the contribution of uncertainty risk to the equity premium is negative, and that's in contrast to the data, and the equity premium is just 3 times smaller. So just to understand why this happens, the contribution of uncertainty shocks to the equity premium is like their price of risk, which is the negative of the SDF responding to the uncertainty shock, multiplied by the market's uncertainty risk exposure, which is how the return on the market responds to that. Now, because uncertainty raises the consumption volatility, and that's disliked by the agent, it of course bears a negative price of risk. And because Q theory essentially holds, investment and stock price can move. So if you don't have our ingredients, uncertainty raises investment because of precautionary saving. So you have a positive uncertainty beta. So the uncertainty risk premium is negative. But with our mechanism, utilization substitutes investment for precautionary saving, meaning investment falls. Firms are negatively exposed to uncertainty. And with a negative price of risk, you get a positive uncertainty risk premium. Now, just on the last point, the mechanism suggests that flexible utilization can be a key determinant of firms' uncertainty risk exposure. So in particular, it predicts that firms whose utilization rate is more negatively sensitive to macro uncertainty, or maybe whose utilization rate is more volatile, they should have a more negative uncertainty beta. Okay, because the idea is essentially that if uncertainty rises and the firm's utilization rate is more flexible, then it would fall more sharply, and therefore it would decrease the future MPK and then drop Tobin's Q and valuation. So I don't have to get through all the details. We do test this in the cross-section of industries for which utilization data is available. So essentially we compute for each industry its utilization exposure, its uncertainty risk exposure, and also how its utilization rate is sensitive to macro uncertainty. And there are certain scatter plots that I'm not going to go through that indeed confirm the predictions that I mentioned from the previous slide. Okay. That's the main message. All right, so I'll just conclude with a few sentences. The paper presents some evidence on the propagation of uncertainty shocks in capital markets, where I think the more provocative evidence is that macro uncertainty is associated with higher capital growth, even though it depresses investment. And that is reconciled by the fact that uncertainty drops depreciation even more. And the mechanism hinges just on flexible utilization and persistent depreciation dynamics, where firms lower utilization to substitute investment for the precautionary saving. Other facts follow from that. And the mechanism has asset pricing implications for either a sizable uncertainty risk premium or trying to maybe microfound the firm's uncertainty risk exposure to uncertainty risk using their utilization policies. So I hope I'm on time, and thank you for the attention.
You're actually perfectly on time. Wonderful. Thank you very much. And the discussant is Lorenzo Garlappi.
Great. All right. Thanks very much for giving me the opportunity to discuss this paper, which I really enjoyed. So let me briefly start with a brief summary. So the paper presents a novel fact, which is that the aggregate uncertainty is associated with shock to aggregate uncertainty are associated with lower investment, but higher future capital growth. That kind of the puzzling fact and new fact that is being put together. And the proposed explanation is that high aggregate uncertainty implies lower capital utilization and lower depreciation. So I premise that I did not coordinate with Gill about the slides here, but I have exactly the same intuition for what this is happening, and it's fairly easy to see from the capital accumulation equation. So if you have a fixed utilization, the depreciation rate delta t is actually a constant. Therefore, in an environment where there's high uncertainty, think about like a real option story where your investment drops. In this setting, you're going to get that the capital is going to be driven by the movement in investments. And instead, if you allow for flexible utilization, then you're basically allowing the fact that you have an intensive margin, which is you can use more or less of your capital, and the utilization here is U. And the utilization, basically what it does move the depreciation. So if you utilize more, you depreciate more, you run out your capital more heavily. So in that case, you might have a situation where uncertainty drops investment, utilization lowers, and depreciation lowers, and therefore capital could be increasing. The intuition here is that essentially utilization is an extra margin that you allow the agent to perform precautionary savings. And especially if you have adjustment costs to capital, that may be a good efficient way to preserve capital during period of high uncertainty. Okay, so that's basically the story, the main story of the paper. And as Gill said, there will be an empirical part and a theoretical part. I'm going to go directly to my comments. I have three comments, and one comment is really about the context for this capital utilization channel. And the second comment is about the modeling of depreciation, and then third, I have broader implication about that. Typically, when a discussant brings up the context of something, it means it dates me, because it kind of gives me kind of a, I've been around a little bit, so I've been trying to put this thing in the context. So let me go back a little, maybe 30 years here, and maybe more. The capital utilization is actually, it's a key concept in a lot of models that feature this capital embodied investment specific technology shocks. And this is the literature that starts in the mid-80s with Greenwood and a lot of papers that follow afterwards. So what are these things? These IST shocks are basically an attempt to model the Keynesian view of business cycles, where shocks to an investment efficiency are important for output fluctuation. And Gill has worked on that, so I'm sure he's familiar with that. So this is kind of an alternative to total factor productivity shocks that are present in the real business cycle literature. However, for this type of shocks to generate the observed co-movement that we see in the macro data, like output, consumption, investment, and labor, capital utilization has to be endogenous and flexible. So this is a key front and center message of this old literature, so to speak. So in other words, the capital utilization captures Keynes' notions of users' cost of capital. So I'm very sympathetic with the idea that indeed, I'm happy to see that the authors put together a new channel, in a sense, through which capital utilization might help us to explain some of the facts. And indeed, in some of the work that I've done a few years back, we show that in a sense similar to some of the thing that Gill showed towards the end of his talk, flexible capital utilization has deep implication for asset pricing, and in particular in this particular case for the pricing of these investment specific shocks. So in other words, pricing of these shocks to the efficiency cost of capital. So in that paper, we show that in a world in which you have fixed capital utilization, once you have positive investment-specific shocks, so the marginal productivity of capital increases. So the representative agent will trade off investment versus consumption. So you have high investment, low consumption, high marginal utility. This leads to a negative price of the investment-specific shock. Alternatively, in a world in which you allow the agent to this intensive marginal utilization, you might easily create a situation where a positive investment-specific shocks leads to high investment, but not necessarily low consumption. So you can actually increase the utilization of your capital. This leads to lower marginal utility and potentially positive price of IST shocks. So the flavor is similar to some of the results that this channel is actually doing for the purpose of, in the context of uncertainty shocks. Another area where capital utilization is really important is in the literature that studies news shocks. Jamovich and Rebello had document indeed that this is an important channel to show, to explain things like sectoral and aggregate movement in macro research. So this paper focuses on yet a different channel, which is this the uncertainty shocks. So I would argue that this is, in a sense, we could claim that this is in the same spirit, because like news shocks or IST shocks, those are shocks in a sense that are useful to predict future fundamentals. And this particular paper gives a unique prediction about investment and future capital growth. So my main comment is really about placing the same this study in a sense in the context of a large literature that has emphasized the role of capital utilization. So the second comment, which is more to the mechanics of the paper, is this idea of depreciation persistence. So the depreciation of the model is persistent. This is a very important channel. And I was struck by this is, I don't know what, figure 2 or something. This is the impulse response function that Gill presented. This is the impulse response function to uncertainty shocks on depreciation. And as you see, and as he mentioned in the talk, you see that there's a large drop in depreciation, and then the depreciation growth persists over the next 15 years. So I was really shocked and struck by that. I haven't thought about that. And this came to me as a big surprise. So that I started thinking a little bit about the modeling of this and what how the model captured this. Again, if we go back to the standard way in which typically depreciation and utilization are linked, and this is a case of, let's say, the model of Jamovich and Rebello, you typically have a constant elasticity type of function like the following. So you have a parameter that governs the utilization. When this parameter is very large, then you have fixed utilization. But this is a one-to-one mapping between the utilization and the depreciation that shows into the capital accumulation. In this paper basically adds a long-run risk, so to speak, component to the depreciation. So the red part over here is new in the modeling of this paper. So if we put the rho delta to 0, then basically we're back to the original the original modeling. And this is really where all of the action happens in terms of quantitatively matching the results. So we need this persistence to bite. We need this rho delta to be very close to 1, so to speak. So to me, this is the biggest elephant in the room. What is the source of this persistence in depreciation? And again, I don't have the answer to that, and I would like to raise it as things to think about. The potential issues with measurement, I tried to look a little bit into how the BA computes depreciation for fixed assets, and I did not find anything that struck me. But it would be useful to have a sense of how this is measured. I don't have a good idea. I noticed that there has been changes in the way in which depreciation has been measured by BA in the mid-90s. There's some smoothing going on in the data, like changing from linear to exponential depreciation rule. I don't know whether that might be a reason, but I think it would be good to dig a little bit deeper into that. And again, maybe the authors know the answer to that. I don't. I just raise it as a possible thing to think about. And then there is the theory component. In the paper, the authors suggest suggest a channel which is a complementarity across different capital vintages. Something like this could be causing this relationship between different vintages of capital, and if capital is complementary, so if you have a shock to the utilization of one vintage of capital, that can translate to the next one, and that can generate some persistence in this depreciation. This could be a useful thing to think about. Another thing that I was thinking was the possibility of financial frictions in a model with heterogeneous firms, in a sense, not unlike what Winston presented in the workshop yesterday. So this idea of misallocation of capital could be an important channel to think about this propagation. The thing I had in mind was something like the relationship between old capital and new capital, like in a recent working paper that Adriano Rampini has, where old capital serves as a cheap collateral for young and productive firms, while new capital is a more costly collateral. So could the heterogeneity in capital, via either through a complementarity channel or through financial frictions of the channel, be at the source, or at least gives us some interpretation for why we have this persistent in depreciation. I think, again, this might be outside the scope of the paper, but certainly something that's worthwhile, in my opinion, to think about. And finally, I just have, this is mainly just a where do we go from here kind of comment, broader implication. What are the, so to speak, over-identifying predictions that give us confidence in the mechanism proposed? And in a sense, I am confident that there is this mechanism is robust because it has been shown in a different context, but it would be good it would strengthen the message, in my opinion, if this was the case. An analogy would be with, they say, in a new Keynesian model, they're designed to explain why real variable move in response to monetary shocks. Then papers like the papers that the author cites, Basu and Bundik, show that this can also be useful to explain uncertainty shocks. So here we have a novel phenomenon. We design a model to explain that. So can we go outside that? So what would this mechanism work for other types of shock? And I think it will. So news shocks, financing shocks, fiscal policy shocks. These are all shocks that, in my opinion, like uncertainty shocks, change the future marginal product of capital. And so I'm pretty sure that this channel would be profitable for explaining other phenomena, modulo the fact that we get a little bit of closure on this idea of persistence in depreciation. Okay, so I think I will, this is my summary. I think it's a well-written paper. I really enjoyed the author, really made it very easy to understand what's going on. So I applaud the author for making my job easy in a sense. It gave me a lot to think about. So I agree that capital utilization is a relevant channel. This has both macro and asset pricing implications. Definitely that. Persistence in depreciation to me is the biggest puzzling part that I would encourage the author to think a little bit more about. And also for the future, this framework, I think it would be relevant for a broader context than what the author have been looking at. And so all in all, I think I appreciate and I thank you for the opportunity to have provided comments on this. Thank you.